Now we'll try to understand how do we measure the growth of the project. So is the project going on a steady pace? Is it declining trend? Is it the growth going on a negative aspect? Or is the growth going on a trajectory basis like a hockey stick? Or is it a steep growth? What kind of a growth is that? You need some metrics, some idealistic analysis or formulas to define to measure the growth of project. So the growth of the project can be measured most only by two ways. One is by way of a revenue analysis. That is, here you measure the growth in terms of dollar value of the sales. How fast are your sales increasing? How much are they increasing? That's the first question. And next, which is a more precise way of analyzing, is the net income or the profit analysis. This is done in terms of percentages, in terms of ratio. So whenever ratio is involved, percentage is involved, you compare one thing to the other, and that gives you a much more better insight. Now, let's go to the Excel sheet and we'll solve the whole thing like I had done in the previous example. Previous case study, we're going to be recreating it from scratch entirely. We'll use the previous example itself, but then you'll have a quick understanding of how the whole build up is done and how you measure the growth in terms of revenue as well as in terms of net profit analysis. Let's begin with the example over here. Oh, I already did some part over here. First, we'll see at the revenue analysis. So we'll measure this project growth analysis by way of revenue analysis. Okay, so over here you have a revenue of $280,000 for quarter 1, quarter 2, quarter 3. Just bear with me for a second. We'll be done with our computations in no time quickly. Okay, so here we have a revenue, total revenue on in quarter 1 of $280,000, in quarter 2 of $286,000, and lastly in quarter 3 of $300,000. So how do you measure the growth over here? Or you can say the increase in revenue. What is the percentage of increase in revenue on a quarter by quarter basis? So you take the first quarter as your standard quarter over here, as your base quarter over here, and then you compare that with the growth in the other quarters over here. So for first quarter, you won't have any percentage because that's the standard or the base, the starting point of the comparison. Next quarter, you have a revenue of $286,000 compared to revenue of $280,000 in the beginning, in the first quarter. So the formula which you're going to use is we're going to take the difference over here, that is 6,000, divided that by the original in terms of percentage, and that gives you a 2% increase in the revenue. We apply the same formula over here. Compared from $286,000 to $300,000, that gives you a 5% increase in the revenue. So you can say that the project has grown to 2% in the second quarter, and from 2% it took a jump to 5% growth in third quarter based on the revenue part. That's how your revenues increased every quarter on quarter. By revenue, we mean the sales over here. Don't confuse this with the net income or the profitability of the project. That's an entire different ball game. We're going to be looking at it in a couple of minutes from now, but this is important just to determine how are the sales growing for the project. Now, the net income analysis is a much more realistic analysis. Why? Because in the net income analysis, the primary reason is that it also takes into account the cost which you incur to derive this growth in the revenue. Okay, sometimes it happens that the cost of the acquisition is far more than the revenue which is derived from the new customer, and hence although your sales will show an increasing trend, your cost is increasing at a higher rate than your sales, resulting in an overall loss in the project on a other side, not the profitability. That's why it's said that the profitability analysis or the net income analysis is a much more preferred method to determine the growth of the project. Also, the management is mostly interested in determining what is the project profitability, not just the increase in the revenue. Okay, so now let's go ahead and see how do you make the analysis of the growth analysis in terms of net income or a percentage. Net income by percentages over here. Before we go ahead, I just want to give you a small heads up. In the net income analysis, there are two methods to determine how a growth is happening. Either you have a increasing revenue as we have in the growth analysis over here in terms of revenue, and then you compare that with the net income or the profit percentages where it's constant on a quarter on quarter basis. And the other part is where your profit percentage is a constant, is increasing, and your revenue is a constant factor. So both of them sound tricky as of now, but just bear with me for a couple of minutes and I'll try to get it resolved completely for you guys. Okay, so the company expected to have a 10% profitability on the project. Okay, and that profit percentage is going to be constant. So now your net income will be total revenue multiplied by the profit percentage, that is $28,000. And the same goes for quarter 2 and quarter 3. So that's how the net income goes to $28,000, increases to $28,600, increases to $30,000. That is one aspect of the growth analysis when you use a net income or percentage method, where you keep the profit percentage a constant factor. You have determined that you are going to be getting a profit of 10% throughout the project life, and that's why every quarter on quarter it's going to be constant. But because of the expertise which you gain in the operational efficiency, the cost of manufacturing efficiencies, and so on, your revenues also starts to increase, and that's how all these factors combining increases your net income by the same amount, by the proportionally the same amount, the increase in your revenue. Now, this is one aspect of the net income analysis where you have a fixed percentage of profit. Fixed percentage of profit. Now we're going to looking at the another aspect where your revenue is a fixed percentage. Revenue is a fixed dollar value. Fixed revenue. Okay. So before we go ahead to the fixed revenue part, let me give you a small heads up when it happens. Most of the contracts which a company enters, which organization enters, they are of at least a year or 2 years in terms of timeline, and they have a defined contract value at the beginning of the contract itself. So what happens in that case is that the company allocates a quarter on quarter a fixed amount of revenue which is going to come recurring to the company. Like say the government makes some of the private companies take up a government project and builds a road for them, for which the government is going to pay them a royalty of a particular tenure. Okay, royalty, license fees, such thing like that. Now that fees amount is fixed for the entity. How the entity can earn profit is by achieving operational efficiencies and increasing its profit percentage on a quarter on quarter, or periodically increasing the profit percentage so year. So here the revenue remains the same because that's a fixed amount determined in the contract itself. However, the entity expects to increase the profit percentage on a quarter on quarter basis. So let's say in the first quarter increases it's 10%, in the next quarter they expect an increase of 1%, and in the third quarter they expect an increase of 13%. So here you have the net income increasing $28,000 in the first quarter, increases to $30,800 in the second quarter, increases to $30,400 in the third quarter. This increase was achieved not by increasing revenue, but by only achieving one thing, that is a great operational efficiencies reduction in the cost of manufacturing, cost of the direct cost of the project materials, and so on. And that is what is termed as an increasing profit percentage over here, where your revenue is constant, but your net income rises only because you're achieving operation efficiencies. So these are the two methods of analyzing the growth of a project. One is in terms of revenue figures of the contract itself, that is this method over here. Next is the method of net income analysis, where you have two methods: fixed percentage of profit, that is this amount always remains constant, and lastly we have growth analysis, net income percentage, which is based on the fixed revenue concept, where this amount always remains constant. Always remains constant. And the same thing happens over here for revenue part, always remains constant. So I hope with this you are able to get a good understanding of how you're going to be evaluating your project, how you're going to justify your project, how you're going to protect your project in terms of the profitability analysis, and next how you are going to measure the growth of your projects. Now sometimes if you have a question in mind that why is it important for me to keep a track of the growth of the project where everything is defined beforehand, it is important. Let's suppose Mr. X had this project going on, and he also had at the same time company had and project being carried out by Mr. Y, who was also doing a profitable at the same operating at the same level of profit as Mr. X project. Now if the entity has to decide, if the management has to decide which one project to continue and which one to drop off because they are having a resource constraint, a time constraint, anything, which happens very much in the realistic world also, the next step they're going to look up is the growth analysis. which project has a better growth prospect and ultimately giving better net income to the company, better profit to the company, and the entity will carry on only those projects which has a good growth potential. So that's why it's also important for you to know not only the income analysis for the existing projects which are going on hand, but what is the growth prospect of the existing projects which are in hand, as well as the project which you're going to take up in the future. With this, we complete the growth analysis of a project also. Now we're going to study one of the most important aspect of a project management, that is cash profit versus book profit analysis. Before we proceed with the actual differentiation between the two, let us understand what is meant by book profit, what is meant by cash profit, and then we'll have a clear understanding of what is the importance of comparison and knowing both of them. So, what is a book profit? Book profit means the profit which is reported by the books of account based on the financial accounting. Okay. Now, the entries which are posted in the books of account, the transactions which are posted as a books of account, are based on an accrual basis of accounting. Remember this term. The books of accounts are built up on the principle of accrual basis of accounting, which follows a matching principle concept. So, what does this concept state? This principle of accrual basis of accounting states that the income which are earned during the period, okay, irrespective of the fact whether they are collected or not, the income which are earned during the period should be reported in that period, and expense which are incurred during the period should be reported in that period itself, to make sure they are matching. The transparency is there. A true and fair representation is made for the period of accounting. So I know the accounting language might be a bit complicated. Let me try to simplify it by giving an example. Suppose the organization pays its employees on the 5th of the next month. The salary, the payroll due for the month of January is paid on the 5th of February. In this case, when the company makes up its accounts on records its expenses in the books of account on January, it will also include one line item, that is salary expenses for the month of Jan, irrespective of the fact that they are being paid in the month of February and not January. That is called accrual basis of accounting. The expenses are recorded when they are incurred. Their date of incurrence is important, not the date of payment. Similarly, when you close a contract and you generate a sales invoice in the month of January, which is going to be collected after 2 months of rate period, say in the month of March, you still record the sales invoice in the month of January to make sure the period in which the sales has happened, the period in which the sales was closed, is recorded in the same period and not when the cash is ultimately collected from the customer. That is what is meant by book profit. When you incur an expense, you record it an expense. When you are liable, or sorry, when you are due to receive a income, you for a particular period, you make sure the income is booked in the same period, not in the future period when it's actually received. Now, based on this income and expenses analysis, you get a profit or a loss amount. That is called a book profit or a book loss amount. Okay, because it's based on the booking of the accounting system. Now let's understand what is a cash profit. Cash profit is entirely reverse of the accrual basis of accounting. Here you follow a cash approach. That is, irrespective of the fact when you made a sale or when you made incurred an expense, you book a sale or an expense only when cash is actually going out or it's coming in. So continuing with the previous example, let's say you had booked a sale on the January, but the collection came in month of March. So when you're following a cash profit system, you will record the sales amount only in the month of March when you actually receive the cash. Similarly, for the expense of payroll, which was incurred in January but paid in February, you will record the cash expense for the payroll in the month of February when cash actually has gone out, not in the month of Jan when it was actually incurred. Now, I hope till now you got the point that both of the system will result in a different profits amount for the projects, okay, for any entity. Now, what is the importance of knowing both the things? We'll just look at an example and that will give you a clear insight as to what is the need for having and understanding of both the cash profit as well as the book profit. So let's see over here. One second, I'll just make one quick change over here because you will need this files for your record. Okay, so let us understand. We'll take this thing over here, the same part, line items over here. Book profits. Okay, just remove all the colors. We don't want any fancy thing going on for this one. Okay, here we have book profits. Here we have our cash profits. Okay, so for the book profit, we made a sales of $800,000 over here, against which the expense incurred was $300,000. So now your gross margin is supposed to be total revenues less the cost of revenues. That gives you the gross margin. Now, based on after the gross margin, you have an operating expenses which were $220,000. Okay, that gives you the operating income of $280,000, and then you have the other expenses for, let's say, $10,000 only. Okay, wait a second. I'll just put one more line item over here, which will be other income. Let's say this was $20,000. So now your net income is going to be operating income plus other income minus your operating expenses. That is $290,000. Okay, so this was based on the book profit. Okay, here you recorded all the expenses which you incurred in the period. Let's say for month of January 2018. Here you recorded all the expenses which are incurred for the period Jan 2018 itself. Okay, now we'll jump on to the cash profits. So in the month of Jan, the company collected a sales amount, cash account receivables from its debtors at sum of rupees $400,000 only. So understand this thing, even though the sales are $800,000, it is not recorded at the entire value. It just recorded the amount of collections actually realized from the customers. Here, and the company paid, let's say, an expense of $275,000 only. It has a credit of $25,000 still due in its account. So it's just going to record an expense of $275,000. That gives the gross margin of $125,000 compared to the $500,000 over here, because the company is not accounting for the sales or for the credit sales over here. Operating expenses, let us say it's supposed to be $200,000 over here. $20,000 is still outstanding, but you only account for what is actually paid till now. That's $200,000 over here. That gives you the operating income, a loss of $75,000. That means it states that the company paid $75,000 extra from its own pocket. It accounted a loss till now. Other income of the $20,000, you realized, let's say, half of the amount till now, and other expenses you paid $7,500. Let's say, keep it safe, $6,000 a year. So now your net income will be operating income plus other income minus other expenses. That is $71,000 over here. So if you see the difference over here, you received an income of $10,000, you paid an expense of $6,000, the balance is $4,000. That is an extra income. So that goes to reducing your losses of $75,000, and that gives you a cash loss of $71,000 over here. So I hope this was clear to you. What's the difference between the cash profit and the book profit? Now we'll just see what is the importance of this both things over here. The key difference over here is that an entity or a project manager has to strive to make sure the gap between the cash profit and the book profit is the lowest, as low as possible. It's rarely going to be the same one, because you don't get the entire collection and you don't pay all the expenses in the same period. But the project manager needs to strive for reducing this gap as much as possible. Why? Because even though if your project is doing great, it has a great profit margin till now, but if the cash profit is less, that means the collections are not happening as quickly as it should be within the credit terms of the company's defined credit terms or the industry credit norms. Then you are losing out on the opportunity cost of the project. Then you are incurring your own expense, own cash flow. You're burning out, you're putting a hole in your own pocket to make sure the project sustains and survives, which is also not a good sign. So by the analysis of this book profit versus cash profit, an entity, a project manager, is able to determine whether the credit period that has been given to the customers is a good one. Is it a reasonable one? Should they reduce the credit period? Should they take other better precautionary measures to reduce the credit period, to deliver better services so that the cash is collected quickly, to deliver projects on much faster pace so that they can realize the cash of the project or the proceeds from the project on a priority basis? The next aspect to compare here is that try to figure out, are they paying up their expenses too quickly? Are they making the full use of the credit period provided to them by their vendors, by their suppliers, by the creditors? Or are they losing out on the opportunity of taking a full advantage of the credit periods? Now understand these things. In India, at least I know this thing. that many of the banks give you an option of creating an FD even for as low as 7 days with an amount as low as just 5,000 rupees, 5,000 INR. So if you have a spare cash of a credit period of 20 days or 30 days period, that's the industry norm. And imagine if you have the cash lying with you and you can pay to your supplier, which is not going to give you any discount, any cash discount search. In that case, you can put this entire amount of extra cash, supposing they say $100,000 in a fixed deposit, and that will give you an interest for a period of 25 to 30 days for the credit period. And when that matures, the interest income goes to the other income, and you pay off your suppliers on time, maintaining a good relation, maintaining your credit reputations, and so on. At the same time, when you don't collect the cash from the customers on a priority basis, right, on the due dates itself, you are losing out the opportunity to earn the interest on those cash. It's ultimately adding another cost to the company. That is the opportunity cost, the opportunity lost to earn interest had that amount been invested by the company itself in a fixed deposit or any liquid fund and stuff like that. So that was important aspect to know what is a book profit, what is a cash profit, what is the importance of analyzing both of them, and how to try to struggle to strive a balance, or you can say close the gap as much as possible between the book profit and the cash profit, resulting in an overall profitability of the project itself. With this, we complete another important aspect, that is the analysis of a cash profit versus book profit. In the next sessions, we're going to be starting with the various ratios involved in the project analysis. Then we'll go ahead and see the various project evaluation techniques, which project to be taken on hand, which project meets the company's expected return on investment, and so on. And lastly, we'll have a look at how to budget for a project, how do you prepare a budget and forecast for the entire projects, based on which you select which project to take up, which project to be dropped off, and which project to be pursued at what point of time, and so on. Till then, I want you to quickly go through all the slides and examples and just understand what are the steps we took to recreate this entire things from scratch, the computations and all the stuff.